Something is happening right now that should be on the front page of every newspaper in America. But it's not, because the implications are so severe that almost nobody wants to say out loud what it actually means. 5 major countries spread across 3 continents, representing over 2 billion people and roughly 15 trillion in combined economic output, are simultaneously selling United States Treasury bonds. Not slowly, not cautiously, aggressively. In the past 18 months, these 5 nations have collectively dumped over $400 billion in American government debt. $400 billion. That's bigger than the entire economy of Austria. That's more than twice the GDP of Vietnam. And it's moving out of U.S. treasuries and into assets that do not depend on American fiscal stability or dollar dominance. Let me be crystal clear about what this means. United States Treasury bonds have been considered the safest investment in the world for over 70 years. Every central bank holds them. Every pension fund owns them. Every major financial institution uses them as collateral. They're the foundation of the global financial system. So when major countries start dumping these bonds all at once, they're sending a message. They're saying they don't trust the United States to manage its debt anymore. They're saying the dollar isn't as safe as everyone believes. They're saying the era of American financial dominance is ending, and the timing matters. This isn't happening during a crisis when everyone panics. This is happening now in early 2026, when stock markets are near record highs, unemployment is relatively low, and the Federal Reserve insists everything is under control. This selling is calculated, strategic, and coordinated enough that it forces one question. Are these countries talking to each other? Or are they simply reading the same warning signs and reacting at the same time? The 5 nations are China, Japan, Saudi Arabia, Brazil, and India. Together, they represent the largest creditors to the United States government outside of America itself. Together, they hold nearly $3 trillion in U.S. debt. And together, they are exiting at a pace that has rarely been seen in peacetime. Today, I'm going to show you exactly who's selling, how much they're dumping, why they're moving at the same time, and what it means for your money, your savings, and your standard of living. Because if the world loses faith in American debt, everyone holding dollars is about to feel consequences they didn't see coming. If you want to follow this stuff the smart way, join the Buffett Academy. You'll get exclusive weekly videos showing the exact stocks I'm buying, plus the Millionaire Blueprint, how I research, build conviction, and position for the next decade. If you want the playbook, it's in the pinned comment. Now let's start with the biggest player, China. Because what China is doing is not just selling bonds, it's dismantling 70 years of economic integration with the United States. As of December 2025, China holds about $759 billion in U.S. Treasury securities. That makes them the second largest foreign holder of American debt, just behind Japan. But here's what matters. In 2013, China held $1.3 trillion. They've reduced their holdings by $541 billion over 12 years, a 42% reduction, and the pace is accelerating. In the past 18 months alone, China has sold about $136 billion in U.S. treasuries, more than they sold in the previous 3 years combined. They're not trimming positions, they're executing an exit strategy. Why? 3 reasons. First, geopolitical tension. The U.S.-China relationship has deteriorated dramatically since 2018. The convinced of trade wars, technology restrictions, Taiwan tensions, military posturing. Every escalation increases China's risk that its treasury holdings could be frozen or sanctioned. They watched what happened when Western countries froze Russian central bank assets after the Ukraine invasion. China doesn't want America holding that kind of leverage over them. Second, de-dollarization. China has been building an alternative financial system for years. Belt and Road, the Asian Infrastructure Investment Bank, currency swap lines with dozens of countries, digital yuan development, everything designed to reduce dependence on the dollar. Selling treasuries fits perfectly. Why hold dollars if your long-term goal is a world where the yuan dominates trade in Asia? Third, domestic economic pressure. China's economy is slowing. Real estate has been cracking. Local government debt has been ballooning. Youth unemployment has been a major issue. They need capital at home. Selling treasuries and bringing money back becomes logical when internal stability becomes the priority. But here's the critical insight. China isn't selling treasuries randomly. They're buying gold, massive amounts of it. In 2023, the People's Bank of China bought more gold than any other central bank in the world, over 200 tons added. In 2024, they continued aggressive purchases, and in 2025, the buying accelerated even more. Why does that matter? Because gold is the ultimate hedge against dollar decline. If you think the dollar is going to lose value, you sell dollar-denominated assets like treasuries, and you buy hard assets like gold. The numbers tell the story. China's gold reserves have increased from roughly 1,500 tons in 2013 to over 2,250 tons today. At the same time, their treasury holdings fell from $1.3 trillion to $759 billion. That's not coincidence, that's strategy. And here's what makes this dangerous for America. When the second largest economy on Earth systematically exits your debt market while building an alternative financial system, other countries don't ignore that. They start asking whether they should follow. And once doubt spreads, selling accelerates. Now let's talk about Japan. Because Japan's situation is completely different from China, but the outcome is the same. They're selling. Japan is the largest foreign holder of U.S. treasuries. As of late 2025, they hold around $1.2 trillion, down from roughly $129 trillion at their peak in early 2022. That's a reduction of about $90 billion over 3 years. That might not sound dramatic compared to China, but Japan is America's most loyal ally. They've supported U.S. fiscal policy for decades. Japanese institutions have been reliable buyers of treasuries when others stepped back. So if Japan is reducing exposure, it signals something fundamental has changed. And the reason isn't geopolitics, it's economics, pure math. For decades, Japan had near zero interest rates at home. Japanese investors had no choice but to buy foreign bonds to earn any return. U.S. treasuries paying 2% or 3% looked attractive when Japanese government bonds paid basically nothing. But that dynamic has reversed. In 2024 and 2025, the Bank of Japan began moving away from the era of zero-rate policy. Japanese 10-year government bonds have offered yields around 2.38%, the highest since the late 1990s. So now, Japanese investors can earn real returns at home without currency risk and without foreign exposure. What happens next is obvious. They repatriate capital. They sell U.S. treasuries and buy Japanese bonds. This isn't hostile, it's rational. But the impact on the treasury market is the same. Supply rises, demand weakens, prices fall, yields rise, and U.S. borrowing costs increase. Japan's selling also spiked at points. At one stage, about $119.3 billion was sold in a single quarter, the steepest quarterly drop since 2012. And here's the trap for America. Japan isn't selling to punish the U.S. Japan is selling because it makes financial sense. But when your largest foreign creditor steps back, even for rational reasons, it creates a structural problem. Who replaces that demand? The Federal Reserve can step in and buy bonds with newly created money, but that risks inflation. Domestic buyers can absorb some supply, but American institutions already hold trillions and aren't eager to load up even more. Foreign buyers could step in, but as you're about to see, many of them are selling too. Now let's talk about Saudi Arabia, because what Saudi Arabia is doing may be the most significant shift of all. They're not just selling treasuries. They're weakening the petrodollar system that has supported American financial dominance for 50 years. Saudi Arabia held around $135 billion in U.S. treasuries as of mid-2025, down from over $180 billion in 2020, a decline of roughly 25% over 5 years. But the bigger story is oil. For decades, Saudi Arabia sold oil almost exclusively in dollars. Every barrel traded required dollars. That created constant global demand for dollars. Countries needed dollars to buy energy, which supported the dollar's value and made it easier for the U.S. to run deficits. But that exclusivity has been fading. Saudi Arabia has increasingly signaled openness to accepting multiple currencies in energy trade, and the direction is clear. More settlement and non-dollar currencies over time. Saudi Arabia has also deepened energy and investment ties with Asia, especially China. Deals that allow settlement in yuan, that's trade volume that used to require dollars and now doesn't. Less forced dollar demand means less automatic support for the dollar system. Saudi Arabia is also diversifying reserves, increasing strategic partnerships outside the traditional U.S.-centric framework, and aligning with a more multi-polar world. Why? Three reasons. 1. They watched what happened to Russia. Assets can be frozen. That risk is no longer theoretical. 2. They see the global shift. China is a top buyer of Saudi oil, and Asia is where demand growth lives. 3. They're hedging against America's changing energy posture and priorities. In short, they're reducing reliance on a single partner. And when a key oil power weakens the petrodollar structure while reducing treasury exposure, it accelerates the erosion of dollar dominance because oil has been one of the most powerful engines of global dollar demand for decades. Now let's talk about Brazil and India, because these two represent something different. Rising powers making strategic decisions about their future alignment. Brazil held about $241 billion in U.S. treasuries at peak in 2019. As of late 2025, they hold roughly $25 billion. That's a reduction of around $216 billion. India held over $240 billion at peak. Now they hold around $210 billion, a reduction of about $30 billion. Both countries are core members of BRICS, an economic bloc that includes Brazil, Russia, India, China, and South Africa, with additional members added in 2024 like Saudi Arabia, the UAE, Egypt, Ethiopia, and Iran. BRICS now represents a massive portion of global population and a significant share of global output, especially measured at purchasing power parity. This isn't a fringe club. This is a serious attempt to build parallel financial rails. They've discussed alternative settlement systems, expanded currency swaps, and institutions like the new development bank structures designed to reduce dependence on the dollar. Brazil and India trimming treasury exposure fits into that broader direction. Diversify reserves, expand non-dollar trade, prepare for a world where the dollar is one major option, but not the only option. And this matters because Brazil and India aren't traditional enemies of the U.S. They're pragmatic. They see the U.S. running massive deficits. They see political dysfunction. They see debt climbing faster than the economy. So they do what rational creditors do: reduce concentration risk. When even friendly or neutral countries diversify away from your debt, that's not anti-American. That's a confidence signal. Now the bigger question: why are all five selling around the same time? Why now in 2025 and 2026? Because multiple forces have converged into a perfect storm that makes holding U.S. debt less attractive. 1. U.S. debt levels. Roughly $36 trillion in national debt. A debt-to-GDP ratio around 124%. Annual deficits around $2 trillion. Interest costs that are becoming enormous. Foreign creditors see these numbers and ask the obvious question: is this sustainable? 2. Interest rates. Rates surged from near zero in 2020 to above 5% in 2023, then around the mid-4% range. When rates rise, the value of existing bonds falls. Investors holding low-yield bonds take mark-to-market losses. Many sell before losses deepen. 3. Reserve currency competition, BRICS frameworks, currency swaps, digital currency projects, and growing gold accumulation all signal that alternatives are being built. Even if the dollar remains dominant today, the direction of travel makes dollar concentration feel riskier. 4. Geopolitics, sanctions, asset freezes, and rising global tensions have changed how countries think about safe reserves. Political risk is now a core variable. 5. Trade policy uncertainty. Tariff threats and an America-first posture can spook not just rivals but allies too, because it signals unpredictability. 6. Alternatives. Gold at or near highs. Domestic bonds becoming more attractive in countries like Japan. Regional investments growing. The world suddenly has more options than just buy treasuries. So, no, it's probably not 5 countries meeting in a secret room to coordinate a dump, but it is 5 countries reading the same signals and reaching the same conclusion. U.S. debt is riskier than it used to be, and diversification is prudent, especially before the crowd wakes up. Now, here's what happens next. Because when major holders sell at scale, it can create a cascade. Here's the mechanics. When big holders sell, prices fall. When prices fall, yields rise. When yields rise, U.S. borrowing costs rise. When borrowing costs rise, deficits get bigger because interest expense expands. When deficits get bigger, the government issues more debt. More supply hits the market. If demand doesn't match it, prices fall further and yields rise again. That feedback loop is what turns selling pressure into a potential spiral. And the numbers are sobering. Foreign holders own roughly $8 trillion in treasuries. If even 10% of that exposure meaningfully exits over a short period, that's $800 billion that has to be absorbed. Who buys it? Domestic buyers can absorb some, but they already hold enormous treasury positions. The Fed can buy, but that risks reigniting inflation if it's financed by expanding the money supply. If neither steps in meaningfully, yields have to rise high enough to attract new marginal buyers. How high? Maybe 6%, maybe 7%? And at 7%, interest expense becomes crushing. On $36 trillion of debt, the implied annual interest burden can approach levels like $2.5 trillion over time. Numbers that start eating a terrifying share of tax receipts. At that point, the government faces brutal choices. Cut spending hard, raise taxes, inflate the debt away, or some combination, none of them painless. And once markets start pricing treasuries as riskier than before, reversing that perception is incredibly difficult. Confidence is built over decades and can be lost in weeks. We've seen versions of this movie before. Mexico in 1994, Asia in 1997, Russia in 1998, Greece in 2010. In every case, the crisis felt sudden to the public, but the warning signs were visible. Creditors pulling back, borrowing costs rising, politics blocking solutions. Now, the US is not Greece and it's not Argentina, but the US sits at the center of global finance, which is exactly why the stakes are bigger. The world runs on the assumption that US treasuries are the ultimate safe collateral. If that assumption cracks, the shockwave doesn't stay contained. Now let's bring this down to your level, your money, your savings, your day-to-day life. Because if borrowing costs spike and confidence weakens, the ripple effects hit regular people first. 1. Interest rates on everything rise. Mortgages, car loans, credit cards, business loans. If treasury yields surge, other rates follow. A mortgage that's 6.5% today can become 8% or 9% fast. That changes affordability overnight. 2. Inflation can return. If the Fed steps in aggressively to stabilize bond markets, liquidity expands. If that expansion hits a supply-constrained economy, price pressures can come back. 3. Stocks can reprice violently. Higher rates compress valuations. Recession fears cut earnings expectations. Retirement accounts feel it immediately. 4. Unemployment risk rises. If credit tightens and demand slows, companies cut, layoffs increase. 5. Government budgets get squeezed. If interest expense eats more revenue, something has to give. Either spending cuts, higher taxes, or both. 6. Social and political tension intensifies. When people feel poorer, when jobs get shaky, when costs rise, trust erodes. That's not theory, that's history. So here's the big picture. China is executing a long-term treasury exit while building gold reserves and alternative financial rails. Japan is reducing treasury exposure because yields at home finally compete. Saudi Arabia is diversifying and weakening the automatic dollar energy link. Brazil and India are trimming exposure as BRICS expands and builds parallel infrastructure. Together, they've dumped over $400 billion in a short window, and the trend points toward more diversification, not less. This doesn't mean the US collapses tomorrow, but it does mean the world is quietly repricing what risk-free really means. And if foreign demand keeps weakening, the US will have to pay more to borrow. At the same time, it's borrowing more than ever. That's the definition of pressure building under the surface. If you want to invest as a top investor, join the Buffett Academy. You'll get exclusive weekly videos showing the exact stocks I'm buying, plus the Millionaire Blueprint, the full framework I use to find long-term winners and build wealth through real conviction. It's all in the pinned comment. And make sure you subscribe because this story is developing in real time, and the decisions people make over the next 12 months could matter a lot more than most realize.